analysis we're going to be discussing now. So there are three types analysis. And they include number one, we have the number two, we have the technicalanalysis, and then number three, finally, we have the sentimental analysis. So these are the basic types of forex analysis we have in the market, in the forex market. So these are the basic types of forex analysis we have in the forex market. There are three basic types of forex, or there are three types of forex market analysis rather, and then they include what the and these three types of forex analysis include the fundamental analysis, technical analysis, and sentiment analysis. So let me draw this line. So now begin to explain each and every one of them one after the other. So let's take the first one, which is the fundamental analysis. So fundamental analysis. All right, so what's just for me, we'll start with what is forex analysis. Forex analysis just has to do with what it's all about. It just has to do with the ability to be able to do what identify buying and selling opportunities in the market. That's just what it is, right? So forex simply is foreign exchange, which has to do with the exchange of one country's currency with another country's currency, right? So it's just like approach or a method or a way, to which you approach the forex markets, right? So as to be able to identify the buying and selling opportunities. So there are three ways to which traders or people that trade forex access the market. And these three ways include the fundamental method, which you have to do with the fundamental form of analysis, the technical form of analysis, and then the sentimental form of analysis. The goal of all this analysis is to do what? Just say, okay, the market is moving this way. I want to buy at this particular point. So how do I identify where I buy from? So you can look at the market in the fundamental style or in the technical style or the sentimental style to be able to determine where possibly the market can buy from. There are just different ways of viewing the market or different way of approaching the market so as to be able to determine turning points in the market. That's what I mean by turning points, is where the market is going to sell from or where the market is going to buy from. So these are the only three types of forex analysis we have. Every form now, so other strategies that persons or individuals now use in approaching the market can be classified under any of these things. So, but can the three sessions or can the three types of analysis be combined? Yes. You can use both the fundamental analysis, you can use both the technical analysis, and then you can use both the sentimental analysis. So any form of analysis you want to use, you can use it. All right, so let's now look at what fundamental analysis is. So what is fundamental analysis? Let's just steal definitions from Google. Then I will explain what fundamental analysis. So, no, sorry, let's not use Google, let's use Investopedia. Investopedia. Fundamental analysis. Fundamental analysis definition. So, what is fundamental analysis? It is fundamental analysis, also known as LSFA, is a method of measuring a security's intrinsic value by examining related economic and financial factors. Fundamental analysis study anything that can affect the security value, from microeconomic factors such as the state of the economy, industries, and all those big grammar that they're trying to blow there just to explain something very simple. You get? So in what they're just trying to say in essence is that fundamental analysis is just a method for you get measuring, that is a method of identifying trading opportunities. Let's just use that, or a method of identifying the value of a particular aspect. One of the times we were discussing at our beginning class, we were discussing on how to be able to identify trades. Like, for example, now in the case where we're looking at buying NGN or trade, so the ability to be able to determine the value of any particular currency within a space of time is to attempt to that. You get that is so. What have they now do that they try to get different economic they try to get different news. So fundamental analysis majorly use news to be able to do what to identify trade opportunities. They listen to news, they're studying the economy, political economy, or they're studying political news. They're studying the country's economy, they're studying so many things to be able to tell the strength of this current country's currency, now to be able to determine where possibly they can enter a buy or a sell from. So that is just what fundamental analysis is, right? That is just what it is. So it uses news. All right, so fundamental analysis involves the use of political, economic, and social factors on news to determine the trend of an asset, not an trend of an asset and possible turning points. So what does that mean? Fundamental analysis just do what uses news. So they read news. What they do is just use news to be able to tell, okay, now based on what GAP said, that the US dollars should have the potential to gain momentum to the upside, or gain, or it has the potential to do what, add more value in the sense it's going to go higher or it's going to go lower. So they just listen to political news, listen to social news, listen to economic news and all those things. So they use it to determine the value of an asset and then the possible direction of the asset. But of course, if the US dollar is gaining value, what do you expect it to do in the chart? It should be doing what? It should be buying, it should be going up, right? It should continue going up and continue going up. So that is just what this fundamental analysis is all about. So it's just using political news, economic news, and social news, just majorly news. And then where can you find all this kind of news? And now you can find them in places like forexfactory.com. You just go there and then you want to listen to news and you want to check out news. You come up here, you can see this news calendar, right? So you just come here and then they look at news, right? You just look at news to be able to determine turning points from the market. So you just use the use of political news, economic and social news to determine the trend of an asset. So then over to the next type of analysis, what is technical analysis? So we have technical analysis. So now let's look at what is technical analysis. So what is technical analysis? Technical analysis is a range of techniques used to try and forecast future price movements of financial products based on past historical price movements and patterns, right? So I love this definition. Let me do copy and paste. So let me just copy and paste to save time. In the video you watch the definition I gave. Always look for that. So but still the same thing. Oh, it's just the numbers that is different now. So right on the V, let me break all these things down. Then explain what they mean so we can write fast. So technical analysis is a range of techniques used to try and forecast future price movements from what financial price, is a range of techniques used to try and forecast future price movements of financial products based on historical price movements and patterns. So where fundamental uses news, they read news to be able to determine the trade and then take trades. In technical analysis, they don't read anything like news. What we look out for is something like this. Let me open this kind of charts now, right? So let me use this binary.com to give volatility indices chart to look at what we have here, right? Technical analysis, from the definition now, it says it is a range of techniques. A range of techniques. Let me start with that one. A range of techniques simply means different form of strategies, and there are different ways of analyzing or using, or different form of techniques in using in trying to pull out this technical analysis in determining a possible trade or taking a possible trade in the forex market. Some persons you see them using trend line strategy. Some persons you see them using so many things, trend line strategy. Some persons will be using Y curve. Some persons are going to be using head and shoulders patterns and all those kind of things. So you see different forms of analysis that people employ as in a way to read, right, or in a way to be able to forecast future price movements from historical price movement and patterns. So, for example, now you see this now in fundamental analysis, for them to be able to determine that, okay, maybe at this particular point, market is going to start turning, right? They'll have to go and look for what's news. That once markets come here, they will do what, start turning and then start buying before they will start selling it. They have to do what, listen to news to be able to determine that. But in technical analysis, we don't listen to news. All the informations we need are what, in the charts. They don't listen to news. All the information they need are just in this simple chart and this plain chart. So how did they now determine future price movements? They determine future price movement, just like the definition gave that we got, from what price must have done in the future, right? So people can now come and say, okay, based on this, for example, now the trend line guys can now come and say that, oh, that each time price gets to this trend line, there's always what, a bouncing. Right, there's always price always bounce whenever it comes to this trend line, or maybe you see something like this now. That, oh, this is a trading channel. That each time price comes and hits this particular point, it always does what, it's reject. So you come and see it now. So some guys look at this and say, okay, let's imagine that price was still. Oh, I cannot use the replay tool here. So let me open the standard trading view so I can use replay tool and teach the things I want to teach. So, for example, now what happened here? Some guys will see this trade, like the trend line strategy guys, they will see this trade. So what are they trying to do? This is the current price of the market, right? This black line. So they're trying to determine where possibly can the market go to. Will the market buy or the market sell? So some of the persons that trade trend line, what we they see here, they'll say, okay, wow, look at this trend line, look at what the market is doing here. I notice that each time market comes to bounce from this trend line, it's going to begin to buy. So even if market starts, maybe it's selling. Once it gets to this trend line, it will buy. Once it gets to the trend line, it will buy. Once it gets to the trend line, it will buy. Once it gets to the trend line, it's going to buy, right? So and then looking at what they are seeing, right? So they can now say, oh, I don't need to listen to any news. All I just need to understand that I am a trend line strategy a trader. Maybe I trade trend line strategy. And so all you need is to just wait for price. Whenever price go up and come down to the same trend line, then we'll now do what? Execute trade. So maybe their analysis is just done by trend line. And remember, the definition we have here says involves a range of techniques. So there are so many ways to which somebody can look at the market. Everybody does not look at the market the same way. So now let's watch what's happened again when price goes to that trend line. This one now, so price now did was start shooting up, right? So it was at this last particular buy, at this last touch, that was price after then buying. So at the beginning you had entered there now, taking that trade, say, okay, once price bounce to this particular point, I'm going to set my stop loss here and I'm going to take the trade up to this particular point. You would have gotten a 1 to 8, and I'm going to explain all these 1 to 8 ratios when we'll be having a risk to manage and risk to reward management call. So means here having a risk to reward of 1 to 8, in the sense that you're risking 1% to get 8%. So what about the definition of your 1%? So maybe say your 1% is you're risking $10. So once this now moves 1 to 8, how many dollars are you going to make in? About $80. You get. So they use now what strategy were they able to use to identify this one? They were able to use what trend line strategy, right? Some other persons will come and then say, okay, no, the strategy that we use is what the order block strategy. So they will come here and say, okay, I can see this order block from here now. Okay, the strategy they're going to use is what order blocks. So they can say, okay, I trade order blocks, just structure and order blocks that I want to see price coming to this particular place and then continue to sell from there. What will they now do? They will now put their sell limits, put their stop loss, say, okay, this is how much I'm willing to risk, and then this is where I want to take my profit. And then they will now do the analysis. So they are trying to determine the future price from what price has done before. That is what technical analysis is, right? So by the time you now play and then see how the price came, activated them, and then did what? Went down to hit their take profit, right? So you see that this kind of persons now did not use this person now in this case did not use what we call the trend line strategy, right? He used his own strategy. So there are millions and millions there. So there are hundreds of strategies that can be employed in this forex market to be able to trade profitably. So your own is just discover your edge, know what works for you, and then do what it. So this is what technical analysis tries to resolve. Technical analysis is just the use of different techniques to be able to determine future price or future price movement of financial product. What financial product simply means is of the particular assets you're trading now. So like in the case when we're looking at Euro USD. So it's just using different techniques to be able to predict where the market is going to based on what market has done before. Whereas fundamental is just go and read news and then do what, come and apply it. So that is just how we continue to do what, identify these opportunities in the market using different forms of analysis. Then the last form of analysis is a kind of analysis that's even funny, but we'll still use it. We'll just still discuss about it. And that is the sentimental analysis. Sentimental analysis. So what is sentimental analysis? Let's see what Google will tell us. What is sentimental? So this is the process of identifying the position of traders where net or whether net long or net short to be able to influence your own trading decision. So forex analysis is the process of identifying what. Let me copy to. The definition is okay. So let's just use it. Then let's break it down so it can fit into the page properly. Sentimental analysis is the process of identifying the position of traders, whether net long or net short, to influence your own trading decision in the currency market. So how does sentimental analysis work? Sentimental analysis, these guys, they majorly use indicators, right? They're majorly indicators traders. So they're trying to determine the volume of buyers and sellers in the market. So when they come and then they say that, okay, this particular asset, remember the definition of particular asset, right? Trying to influence your own definition in the currency market. So depending on the particular assets you're looking at. So for example, now in this USD JPY, some persons just come and said, okay, based on what price is doing today, which persons have the momentum more? Is it the buyers or is it the sellers? So what they're trying to study is the sentiment in the market, the war between the bulls and the bears, that is the people that are buying and the people that are selling, right? So they're trying to understand the sentiment of the masses. They're trying to understand the opium of the masses. What is the masses saying? Are the masses saying that they're going to buy this pair, or are the masses saying they're going to sell this pair? So if the masses are saying I'm going to buy, I want to join them to buy. If greater percentage, I'm saying I'm going to buy, that means I will join them to buy. If greater percentage is saying I'm going to sell, that means I'm going to join them to sell. Right? So they just use sentiment analysis. So but how will you be able to, like, there are over how many billions of persons or millions of persons trading forex? So how will you be able to know the opinion of the mass? So you will know the opinion of the mass by the kind of orders they execute in the market. So by number of people buying and selling in the market, you can now see it in the market. So how do they measure it? Some persons now use what we call the volume indicator. So for example, now they come and then they put out this indicator you can see down here now. So this indicator can now be able to, I'm not teaching how to use the indicator. That is, I don't even use it, you get. So, but the indicator now teaches the volume of the buyers, the sellers in the market. So at this particular point, you now come and say, okay, people appeared more in the market. Was it the buyers or was it the sellers? Or at this particular point, which people appeared more in the market? Was it the buyers or is it the sellers? So as this volume continues to print, and then they are studying the volumes, studying what price is doing in the volumes, right? So they're not able to now say, okay, based on this, the mass wants to do what they want to buy, and based on this, the mass wants to do what they want to sell. So I'm going to join the mass in this people, in this case to buy, or I'm going to join the mass to do what to sell. So they use indicators. They're majorly indicators traders. And when you see so many people's charts with indicators, full of indicators, and then they are reading charts of indicators, you just know that they are measuring what we call kind of the sentimental forex analyst, right? And then you can also combine the three of them. You can combine fundamental analysis, technical analysis, and sentimental analysis to even give you better opportunities. Yes, you can combine the two of them, right? So that is these are the three types of forex analysis we have. And this was the definition. It is the use of political, social, and economic needs to determine the effect of an asset so as to determine decide a buying or selling point in the market. This was the definition I was looking for. So this was my definition of the three kinds of forex analysis. So now let's now go into candlesticks, right? So I don't know, can you see my screen? Can you see the image? Please, if you can just let me know. Just give me a second. So what are forex candlestick? A candlestick is a type of price chart using technical analysis. Take note, candlesticks are majorly using technical analysis, right? That displays the high, low, open and closing price of a security. What security simply means is just an asset, right? Whether it's Euro USD, NZD USD, NGN USD, and the whole of all that. So they display what the high, the low, and open, high, low, open and closing prices of a security asset for a specific period. So there are two types of candlesticks that's used to form, and that is the bullish candlesticks and what the bearish candlesticks. What is bullish? Remember, we said bullish just simply the act of buying. What is bearish? Bearish just simply means the act of selling, right? When somebody says I'm going bullish, what I'm buying. When somebody says I'm going bearish, what I'm selling. So bullish means a buying trend. Bearish means what? A selling trend. So there are also two types of candlesticks that used to form. We have the bullish candlesticks, which is the candlestick that indicates buying momentum, and then we have the bearish candlesticks that indicate what? The selling momentum. So now, the condition in identifying a bullish candlestick when they form, or the type of bullish candlestick that forms, is this: that for bullish candlesticks, the close is always above the open, right? And for bearish candlesticks, the close is always below the open. So the close for the bullish candlestick is above the open, and then the close for the bearish candlestick is what? Below the open. So let me explain. So from here now, what you can see here, this is the bullish candlesticks. These are the paths. This green body now is bullish candlestick. Now this is a candlestick that is buying. That when the market is buying, this is the kind of candlestick it should be forming. What the market is selling, this is kind of candlestick that it should be selling. So what the open simply means is that these candlesticks indicate four things: indicate high, low, open, and close. So the high is what the high it simply means the highest point that price got to during the formation of that particular candlestick, right? The highest point the price comes to. Sometimes you see something like a wick form. This is what a wick is. This dashed line above is called a wick, whereas the main body, the inside that is at the middle now, this is what is called the body. The other ones are called wicks. So wick simply means the price or the path through which price pass through before reversing to close either above or below it, right? So the candlesticks displays the high, the close, open, and low. Right. So this high simply means is just indicating the highest point the market went to. And then the low indicates the lowest points the market went to. Right. The open, remember, in a bullish condition, the close is always above the open. In the sense that when a new candlestick is forming now, for example, once markets open here, right? And a bullish candlestick, bullish simply means what? Buy. That the candlestick is going to be buying, and then to be buying is to be what's going up, right? That the candlestick is going to be buying and then close above where it opened, right? So when you see a bullish candlestick, you can just determine that, okay, this was where the buy started from, and this was where the buy ended for this particular candlestick. When it comes to selling candlestick, this is the highest point price went to, lowest price went to. But in a selling candlestick, the close is always below the open. So when price open and a new candlestick start falling and start forming, what do you expect? If it's a sell candlestick, price will go down, right? So price is going to do what? Go down, right? And then because price closed below where it opened, that candlestick was a sell candlestick. So that is how we can be able to determine what these candlesticks are in the market. For example, now looking at these candlesticks now, let me go down to the 1 minute time frame. I changed their color. Look, it's not all candlesticks will be green and red, right? Not all candlesticks will be black and white. You can just customize your own. So for my own now, just the buying candlestick in this case now, we use the green scenario to explain, and then the selling candlesticks we use what the red distance to indicate them. Look at what we have here. For me, my selling candlestick is blue in color. My own buying candlestick is what is yellow in color. So that's what I like. I like it like that. It's the color combination is good for me, right? So so for me the selling is the blue and then the buying is the yellow. So now let me even go down to 30 seconds time frame so you can see it from very well. So let us watch closely at where the next candle. So remember I said my own, the buying is the blue. I mean yellow is buying and blue is selling. So let us see where the next candle is going to open from. So let's wait. Look at now the next candle has opened, right? So that is where the open of that candle is now. So the only thing that we can now use to determine if this candle is a bullish candlestick or a bearish candlestick is where this price will now close. Will price close below the open or will price close above the open? If price is below the open, right? This is a bearish candlestick. And a bearish candlestick, selling candlestick is blue in color. But if price retrace and continue going up, right? My bearish candlestick is going to turn yellow in color, right? The color can change, right? It can change. So now you can see a new color from now. This is the open. Price is what? Look at the highest point price straight to before coming down now, right? So those wicks forms as a result of the highest point or the lowest point where price got to before it started reversing. Right, so you can see this previous candlestick ended as a sell. This one now is what is selling. Okay, look at, if it sells, it turns to blue. If it buys, it was turns to yellow. Well, how do you determine it is what? Because where price is price above the open or below the open. So if it's above the open, the candlestick will turn to yellow. If it is below the open, candlestick will turn to blue. So you can see that here, price just closed at where it's opened, right? This one now, when that candle has opened, right? And then it's forming. But what is it doing now is buying. So the color of the candle is what? Is yellow. And then you've seen this is the highest point price got to before retracing. So it just left an evidence of that part that it got to before retracing. So you see that this candlestick opened, bought to this particular point, and then did what? Started selling again, right? So let us see how the candle will close. With the candle still closing a buy, it also closed where it's opened. On that candle has formed again now, right? So wicks, all these wicks we are saying here are simply indicating the highest point where price has gotten to before they retrace to now close here. Now, there are possibilities that a candle will not have a wick, which simply means price got close at the highest point it got to. Look at this candlestick here now. Can you see that? Price got to the highest point, but it did not come down. And then it's, that means there's no need for a wick. Even where it's open, it did not go below where it's open. There's no need for a wick, right? But look at this candle, new candlestick forming, and look at the open. Look at the highest point that price has gotten to, and you can see wicks are now forming. So those wicks are just indications of what where price has gotten to, right? So the formation of this candlestick pattern is something that you should understand and you should be able to see, right? So now, this is a 30 seconds time frame, right? This is a 30 seconds time frame. So what it simply means, look at this long sell now, for example. But this cell is not big, it's just one small tentacles cell. It's just was in the 30 minutes, right? So you can see now that candle closed and was in a large cell. Let's just call it a big cell. So it closed in a big cell, right? So this one now started buying. But what would the candle do? Will the candle close in a buy or will the candle close in a sell? That's for this one now. It started buying. So we want to just watch and see. But now take note that this is a 30 seconds time frame, right? So 30 seconds times 2 we make up what? 1 minute, right? 30 seconds times 2 we make up what? 1 minute. 1 minute times 5 is going to give us a 5 minute time frame, right? So the time frames differs in the chart. You can see multiple kinds of time frames, different type of time frame. We have the monthly time frame, the weekly time frame, the daily time frame, the 4 hours time frame, down to the 30 seconds, even less than 30 seconds. We have up to that, right? So when you look at the candle, maybe for example now on the 30 minutes time frame, you might be seeing this candle what? As a sell, right? But on the 1 minute time frame, it will now appear as a buy, simply because what it means is that in 1 minute time frame, it needs 2 30 seconds time frame candle to make up a 1 minute time frame candle, right? So if, for example, now in this case, let me use this blue and this yellow case now, for example now. So if this first candle closed in what? A sell, right? This other one closed in what? A buy, right? So let's now determine the open price. So this was the open price of this candle. This was the open price, right? Because it was a sell, so the open is above the close, right? So this was the open price of the candle. So let me just draw a candle box. So let me just leave it. So this was the open price of the candle, right? And then we're trying to draw a 1 minute time frame now. What this candle I'm trying to form now is a 1 minute time frame, which will contain 2 30 seconds now, right? So in the 1 minute time frame, the way these two is going to appear on the 1 minute time frame is what we're trying to achieve here, right? So where the price opened at that beginning of the 1 minute, this was where it opened. At the end of the 1 minute, where did it close? Look at where price closed. This yellow line here, right? Because so this was where price closed here. Because what? On the first, when price started selling, the first 30 seconds, this was where it opened. That means on the 1 minute that was opened. But on the second 30 seconds, this was where it closed, right? So that means on the 1 minute, this was the entire move of what? The 1 minute, right? So what these other parts below will now indicate or show us is going to now show us what? A week. That okay, price actually got to as low as this point, or price actually got to as low as this point. So it will not appear as a week what on the 1 minute time frame. Same thing applicable to here. Okay, there's no week there because price did not go above that, right? So we can now see this. So on 1 minute time frame, this is what the candle is going to look like. So this candle now is a formation of what? These two candles, simply because we have the first 30 seconds open here, but the second 30 seconds closed. So we're interested only what? In the open and then the close of the 1 minute. So in the 1 minute, we have this open, we have this close. So anything up below that close is now indicating on the 1 minute the highest price or the point where price got to the closing above, which is now an indication of what? A week, right? That is what we do. So it's something applicable to the 5 minutes time frame. If you want to identify how candlestick form a 5 minute time frame, how many candlestick is going to make up a 5 minutes time frame, or how many 1 minute candlestick? So a combination of 5 1 minute time frame candlestick is going to give you what? A 5 minute time frame candlestick. So you just need to identify the open of the first minute candle and then the close of the last minute candle. That is the 5th minute candle, right? It will not determine the size of your body. Then any other thing outside of that will appear as a wick, which was the largest of the or higher than the lower point where price got to, right? That is why we have this, the bodies and the wick. So you want to, in the higher time frame, the body is not going to just work with the close and open. If you see the body formation forms with what's open and close. The body formation for sell and buy forms with just open and close, whereas the wicks forms with what's high. So in this case now, the body will just be interested in what? The first open for the first 1 minute and then the close of, right? The last 1 minute candle. That's what they're interested in to form the body. So anything outside that price went to will now appear as a wick in the candle. So that is what candlestick pattern is. So as you continue to go, as you continue to even study more, you're going to see the same thing applicable on the higher time frame. 1 hour time candlestick is just times 2 of a 30 minutes candlestick, right? Or a times 4 of a 15 minutes candlestick, or what? A times 12 of a what? 5 minutes candlestick. So you just measure 12 candlesticks, and then that is going to give you what? An hour candlestick. So now check it. Look at this 1 minute time frame now. So what does it do? This candles forms at what? Every single time, right? So now this is 9:05 by our time. So once it's 9:06 now, another candle is going to begin to form. All right, so we have 9:05 here. Now look at that candlestick we just analyzed. Look at it, guys. You see, I did not even look at it before we even look at it. This was the candlestick we are looking at now, right? Look at exactly how it formed, right? So once it's 9:06 now, and that candlestick is going to begin to form. So it just works with times. Same thing applicable to 5 minutes. Every 5 minutes, a new candlestick will form. Same thing applicable to the 1 hour. Every 1 hour, a new candlestick is going to do what? Form. So let's just watch and wait for the next candlestick to form. And then you see the timing too and the timing alignment. So how many minutes take long like this? All right, so 9:06 already, right? So it's 9:06 already. So another candle has formed, right? You can see 9:06, another candle has started forming. So that is just how it works. So let's now go and look at what price or market structure is. All right, so let's go. Market structure. This is what we're going to discuss, right? This is the new subheading we're having, market structure. Let me just create this point here now. Please just take note of this. This course is to end by 10 o'clock, right? 8 to 10. So let me try to run through it before 10 o'clock. So what is market structure? So market structure. Let's now look at what is market structure. Market structure is simply for the directional bias of the market, right? So you can just look at structure. You just simply the arrangement of a particular thing, maybe in an organized pattern, right? I think Merriam-Webster involved putting it too. And I like the way Merriam-Webster puts their definition of what a structure is. So the structure is an arranged or is put and arranged in a definite pattern of organization. Let's just have that word too. You can say that if structure is a definite pattern of organization. So what does market structure seem or aims to, or what is it aiming to solve for us? This in the forex market, right? So it is simply the form of directional bias of the market can also be defined as the pattern of organization in forex market, right? So and there are basically three types of forex markets. All right, so let me just write that out. So these are the types of forex market structure we have, right? So we have the bullish or the uptrend market structure, consolidating, or the bearish downtrend market structure, and then finally we have what's the consolidating or the relative market structure. Let me now explain the three of them, what they are like. So if you remember the definition, market structure is just simply to tell us what directional bias of the market can also be defined as the pattern of organization in the forex market. So in the forex market, you want to be able to identify this asset, is it buying? What is the asset doing? Or when you come, for example, now and say, okay, like the previous example we gave in the NGN what's NGN doing? NGN is selling. Why is it selling? Because the USD has more value than the NGN. Euro USD, what is it doing? Euro USD is buying or is ranging or selling because of what? This particular factor or this particular one has more value than the other one, right? So to be able to now identify the particular structure of a market, there are particular things, there are pattern of organization that you want to see. There are things that you want to see form in the forex market to validate that market is either in a uptrend, bullish, that is either buying, or market is in a downtrend, that is either selling or is bearish, or market is consolidating within a range that is not buying, is not selling, it's just static. Right? So there are several patterns you want to observe in the market. There are things you want to look out to see in the market before now being able to determine and say, okay, this market at this particular point is what is bullish, or this market at this particular point is what is bearish. So let us now look at those class factors. So it's what the bullish. So you have this to be what the bullish market structure, right? We have here, the example we're going to be looking at here is what the bearish market structure. The bearish market structure. And then the final example we're going to be looking at this particular point is what? The ranging market structure. Ranging market. So what is the formation of a bullish structure? How does bullish structure forms, right? And then what are the patterns of organization that we want to see? Or what are the patterns that should be forming in the bullish structure or in the market that before we can see that the market is bullish? Remember, why I say is bullish? Bullish is what? Buying, and bearish is selling. So you want to see market in the bullish structure doing this, forming this, and I'm going to explain what I'm going to tell you what is forming now just in a moment. Let me just draw this. So from here, what can you see? Market is doing what? What is the directional bias of the market? Market is doing what? Buying, is going up, right? So market is what's bullish, right? Then for the bearish market structure, you want to see market coming down, and then this is the pattern through which market is going to come down. So this is the organized pattern through which market is going to come down. Then for the ranging market is neither buying or selling. Market is just within one spot, just staying there. Right? Right. So you just have market staying at one particular point. So you have this is the range. So market is just what consolidating or ranging, right? So it's just called the range market structure. So what are you looking out for before you can say market is bullish? Is it that when the market is just going up, that means it's bullish, or when the market is just coming down, that is buying? The characteristics of a bullish market is that in bullish market structure, this is what you will see the markets doing, right? Formation of higher highs and higher lows. I'm going to explain those things. Let me just write their characteristics there, and I'll now start explaining them. Bearish market structure is forming lower highs, and then it's forming what? Lower lows. So lower high is going to use LH, and lower low is going to use LL, right? For the engine market, it's not forming lower low, it's not forming higher highs. So what then is a lower low and then what is a higher high, right? So for the bullish market, before you say a market is bullish, remember what you say structure can be defined as the pattern of organization in a forex market for a particular asset. So before you can say that this particular asset or this particular market that you're looking at to trade is bullish or is bearish, or the market is bullish, that is buying, or the market is selling, that means it's bearish. It simply means you want to see the characteristics, you want to see these characteristics coming. So sometimes when market is, or anytime the market is bullish, not sometimes, anytime the market is bullish, you always have, first of all, what's formed? A low. Or you always have a low. You always have what's a high. And the market to do what? To retrace. To do what? Form what we call a higher low. Right? Why do we call this a higher low? Because we already have this low here. So, but this low or this retracement that came, or this movement now downward, close above the previous low. So we can now call it a higher low, right? And then we can now call it a higher high. Reason being that this high closed above what? This particular high. Then we can call this what? A higher low, higher low, and then what? Higher high. So as long as market is still forming this pattern, then the market is going to be bullish. As long as you can identify this pattern, then you can now say that the market is what? Is bullish. So let me just write this here. So border and background. So we first of all we want a low, right? And then we have what? A high. Then we have what? A high. It's what? A high low. Then let me just clone them. So in the forex market is bullish. You want to be seeing what? Markets forming what? Highs, lows, high, lows, high, lows, high, lows. And then why would they be forming high lows? Some persons will now ask, but if market is buying, why can't market just continue buying straight up like that? Market will not continue back. So market will not just continue buying. There are days market will do what? Buy or come down, breathe a little bit, buy or come down, breathe a little bit, buy on the whole of all that, right? So you want to be seeing those formations. And then in the case of the bullish market, that's the buy market, the buy leg, which is this leg where market was buying, is always called what? The expansion, whereas the sell leg is always called what? A retracement. So price did what? Expanded and then retraced to break a little, expanded, retraced to break a little, expanded, retraced to break, expanded again. Right? So that buying leg is always called what? The expansion leg, whereas the selling leg is always called what? The retracement leg. There's no call outs to that. So we have to be what? We have expansion, and then we have what? This leg is called what? So in the bullish markets, we have this point, the whole of this move, and so this buy leg, for every buy leg you see, as long as it's buying, it's called an expansion to the upside, right? And then in the case of something candlestick, let's just use normal green and green. So let's color this for candlestick now. Let's give it a green. All right. Then make the green a bit darker. Right. So for every expansion leg or buy leg in the market, you are seeing what that is called. For every buy leg, you call it what? An expansion. Whereas for every sell leg, you call it what? A retracement. Let me give this retracement leg now. Sell color, which is going to be red. Let's just use green and red. Right. So this is just simply what structure is, right? So in a bullish scenario, you want to see price forming higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows. And please, before you call, let me make this secret. Okay. So please, before you call a structure a higher high or a higher low, in the case where the market is forming bullish, forming what? Higher highs and higher lows, higher highs and higher lows. What do you want to see? Before you call this place a higher, before you call this place a higher low, right? A new higher high must be formed. So when market is in this, let me draw down here, it's from higher highs, higher highs. What you call this market is not a higher low. You want first of all see a new higher high. That is the only difference cannot be called a higher low. But once that thing form, once a new higher high form, you cannot call that point the higher low. Right? Once it's what price do was create highs, return higher low, create a higher high, right? Then come down to form a higher low, and then create a higher high. The reason we say that you cannot call this a low, a higher low until a new higher high can form is because sometimes markets do this. Sometimes markets can do this. Start creating, we have higher highs, higher lows, higher highs, right? Higher lows. Yeah. And then instead of creating higher low, instead of it creating a high, we should now consider the structure to the downside and now start forming something like this. So somebody will now be like, but why didn't that? But from what we have here, this point now, the price did what? Higher high, sorry, higher high, higher low, higher high, higher low, higher high. Even though one was supposed to be formed, but why didn't it form? Why did the price not start shifting? That is why we cannot call anything that we see here or anything that we see here but a higher low or even is more realistic now. You see something like this, pricing higher highs, higher lows, higher highs, higher lows, higher highs, price now come here, now come here, now come down, right? Before going down, right? So some person see this thing, and please, I'm just taking this because of the assignment, so you don't make mistake, right? Some persons will see this thing and say, okay, from structure, this is a low, this is a high, yeah, higher low, with higher high, higher low, higher high. Then they will say this is higher low and this is higher high. But why will you call this kind of thing here high? It's not a high reason because what? Or it's not a high reason because what? It did not close above the previous high. So as long as this did not close above the previous high, we cannot call this a higher high. Neither can we call this a lower low, right? So we want to, the validation of every lower low is the formation of a new higher high. The validation of every lower low is what? The formation of what? A new higher high. And if it does that, or give us something like that, we cannot call anything a higher low. So before you now start naming your ranges, what do? You now maybe I'll even use this line chart. Say, okay, this is the previous low, right? Now low, first low. Then we have the high. Then we have this low. Then we had the high. Then we had this low. Then we had the high. So we are waiting for what? A new low to form before giving us a high. But this low here now, or this high, I mean, the above the previous one. Therefore, this is not a high. It is still below the previous high. And then we cannot call it a lower low. I mean, a higher low. The reason because it's a new high has not been formed. Same thing applicable to the bearish scenario. When price is bearish, what they want is price. They want to see price first of all forming what? You want to see price forming a high here first. Want to see price forming highs, then now come here and then form what? Give us a low, lower high, lower high, right? So you want to see price forming lower high. Why is it lower high? Because this high was formed, this low was formed, and then price came up and they want to create a high. It did not close above the previous high. So it is called what? A lower high because it is lower than the previous high. This lower high also is lower than what the previous high. This lower low and high is lower than what the previous lower high. So this is a low. So this market came down below this low. That we are calling it what? A lower low. This market came down below this low, the previous low. That we are calling it what? A lower low. Same thing applicable to this particular point here now, right? So this is now the formation of what? The bearish market condition. And in a case where we have for buying, the buying leg for the expansion and the selling leg for the retracement, same thing is applicable when you come to the selling market. The selling leg in this case will now be what? Our expansion leg. Right? Why the buying leg? The buying leg, yes. Now, this case may be, where will I draw this pull out to? Let me try it down. We now got retracement. Does it mean for price to retrace? It does expansion, right? So For expansion, the concept of expansion and retracement is this: for buying scenario, expand and buy and you retrace. And buying and you retrace. Buying and retrace and all this kind of thing. That is what expansion and retracement. Same is applicable to the selling scenario. This is selling. I'm selling, it retrace a little. I'm selling, it retrace a little. I'm selling and then retrace a little and then it continues doing what it continues selling, right? So this is how we identify a bearish and then a bullish market structure when we want to identify market structure. How we try to identify them. So the pattern, we want this pattern form before we can say the market is bullish or before we can see the market is bearish. In a ranging market is not forming higher highs, it's not forming higher lows, it's not forming lower lows, it's not forming lower highs, right? What is market doing is just within a range, right? Market just have this range, this top range, and then the low range, right? In market structure. So let's now go into the charts to be able to identify what buying opportunities, selling opportunities, or not opportunities now, structures in the market. So let me look for, let's just see let's say AED, right? So let's use AED, or should we use AED? This is for the standard trading view. If it's for the binary trading view, you can have the same thing. For the binary trading view, you see the same thing. Right? The market will not just be a clean setup like this. So sometimes the view in the market might be different. I just need to explain the concept and then the principles behind it. Go down to it. You will see the same apply to any time frame your choice, right? So let's see what price will be here at the particular place. Now, if you want to say from this point to this point, 4 points now, you come here. From this point to this point, what can we say market was doing? You can see the market was buying. Now, how do you identify the buy? Two ways. You look at this chart now. So I'm looking at the information. Now, what we're looking at for opportunities was we want to look at what is forming in the market. And from what I'm saying here, market is forming is what higher highs and higher lows. That means market is bullish. And you can see it. The market was what? Bullish. Right? So, but look at this now. Where issue now comes now at the tail as the main higher highs and lows. And that's to begin to make this. Remember, I said that a higher low cannot be validated until a new higher high has been formed. Right? So if in a candlestick track pattern is going to be an issue to you in identifying this thing, one of the best things you can do to yourself is just turn it to line chart. Just come here and then turn it to line chart. So you can see line. So at least it's going to have almost a similar look like this one, right? So you can turn it to line chart. You now begin to label with the text to identify first of all for me the low, right? So after identifying the low, so right, after identifying the low, what do you want to identify for me? The highs. So you now identify the highs. After identifying the highs, what do you now want to identify? This is what give us sorry, a low. This is the high. Because we're not going back now. This one is coming here. So this was the low, and this was the high. Right? So where is the higher low? Low, reason because it was closed below this one, right? And then we can now say our new higher high here, this high, because what? It's closed above was the previous high, right? Our new higher low is not going to be what? It's going to be this because it was closed above previous higher low, right? Then our new higher high is going to be where? It's going to be here, right? Because price did was closed here now, higher high, right? Because price closed and it's going to be our higher low. Then from the reason we can place higher low is because the new higher high was full. And how we look at this higher high was this was this high here now, right? But this higher closed came above that one. So that was the new high that formed there, right? So after higher high was formed, what can we see? Market did shift momentum. And let me explain what momentum shift is in the market. So for example, these three things can happen in at the same time, right? You can have markets which they're looking what higher highs, higher low, higher highs, higher low. Let's find this on it. Sorry. So you can have markets forming what we call higher highs, higher low, higher low, higher high, higher low, and now from higher. of this forming higher low, it will now close below. And start having lower high, low, lower high, lower low, high, lower low, lower high. What just happened here? Right? Because at the whole of this point, from the whole of this point here, market was doing buying, and then because we are identifying what the characteristics of the market. But from the whole of this point, what was market doing? Your market started selling the whole of this point because what we can see characteristics of what is selling. So what a structural shift, what we call BOS, break of structure, to the downside. So initially, price was doing what it was buying, right? It broke this particular point because this is the structure of the market after forming low, high, higher low, higher low, higher high, higher low, higher low, higher high, and then from higher high. The thing is supposed to be higher low. But price now came and closed to the previous low. And remember, I said that this low can only be validated when a new high is formed, right? So now this low has been validated by the formation of this new. Price was supposed to respect this, but price don't now respect this previous low. Price now was closed above and closed below this. Automatically, what I have here is what we call a break of structure. A break of structure. That means the initial structure was bullish, and then there was a break of structure to the downside. Right? What forming was lower lows, lower lows, which is now evidence of the bearish structure. So you can see that here price was bullish and saw the broke structure at this particular region after turning to bearish. It can be a turn the market. So you can also see these three things come to play at the same time. It depends. It's a picture perfect, right? So you can also have price doing higher highs, higher lows, higher lows, higher highs, and then range a little bit. It's not creating higher highs, it's not creating lower, not creating higher highs, and then it breaks again, creating higher highs, and then break structure to the downside, right? Continue, and then range a little bit. Then market can do anything. You have to be able to then pressure again up. How many because we have? We have this a low, high, higher low, higher high, and then our new higher low is going to be what? This higher low. This one now creates above this previous one, right? So that's going to be our new higher low. There will be a higher high. But where do we now call higher low? This will be our higher low, right? Because this one will close above this. This one will close above this. So we cannot call that for higher high. Not we cannot call this is now what an evidence of what the renting market because it's coming high. But all of a sudden, this high came and closed above this previous high. So automatically, this last one will now be about higher low, right? Then this will have higher high, higher low, higher high before the downside. And by the software, again, before have this ranging and then continue. And then they do break structure into the upside, continue doing higher, higher low. So you can multiple break of structure happen in a particular market at the time, right? So it's in a day. So it's very possible. Very possible. So based on this back as we are labeling, right? So now see. So when price was forming all these things, and one of the ways you can make things easier is when you identify your low, just put a line there. Then when you now identify highs, or when you identify your tick and do line there. So any retracement, want to be observed the retracement will close below the low, or if you have this retracement now, right? And then once that this high has closed above this high, and now the line has said, okay, and this will be a new higher low, and this will be a new higher high, right? The reason I'm saying is so somebody will not come out tomorrow and then label this for me as higher, because this cannot be a higher high, right? Label part as higher high, because this cannot be higher, because it's not close above the previous high. So that is it. So from here, what comes to here, they now see why price was creating the whole of all this, like creating this higher high. Instead of it to expect this higher low and continue going, it did what broke pressure to the upside, to the downside, right? And started creating lower low, lower high, lower low, pressure to the upside, right? And started creating what higher highs, higher lows, higher highs, and broke pressure to the downside. And started creating what higher lows. Lower highs, lower highs, the block of that and into the upside. So you can have buy, sell, buy, sell, and buy. So you see that series of breakups happen here, right? So your ability to be able to identify this in the market is what is important, right? So how do you do this? When you open either your trading binary, which is synthetic trading app, either you open this one, come here, turn to line chart to make it easy. Anytime frame, 4 hours, 1 hour, anytime frame, short, just on to line chart so you can see what is happening now. I look at what is happening here now. What's happening here? A sell trend, right? You can see this high, then we can see lower low, lower high, lower low, lower high, lower low, right? And then I go to particular points. At this point, we can see a lower high. Reason being that a new lower low was not formed, right? So we just want the validation of a new lower or the validation of a lower high is not going to be on the basis of the formation of a new lower low. So that's why we call this, even after doing this lower high, lower, we will not call this a lower high because a new lower low was not formed. Okay, that's doing it won't form that then broke structure by closing above the low here now. So you can use either of these charts or use the normal thing. A good knowledge of what market structure is. You not understand any other thing when it comes to forex. Market structure is the foundation of everything, fam.